What caused one of the most devastating financial disasters in modern history? The Wall Street crash of 1929 didn't just shatter markets, it shattered lives and reshaped the global economy forever. In this documentary, we'll uncover the origins, the dramatic unfolding, and the profound consequences of the Great Crash. Join us as we explore how unchecked speculation, economic imbalances, and panic combined to bring down the Roaring Twenties and usher in the Great Depression. The story of the Wall Street crash begins long before October 1929. After World War I, the United States entered a decade of remarkable economic expansion known as the Roaring Twenties. Industries boomed. Steel, automobiles, construction, and consumer goods all surged. Urbanization accelerated as millions left rural farms for city jobs. The stock market mirrored this optimism, with prices climbing steadily year after year. Many Americans, from bankers to factory workers, were swept up in the speculative frenzy. Buying stocks on margin, borrowing money to invest became common, even among those with modest incomes. This practice magnified gains but also risks. Despite the apparent prosperity, deep economic problems were brewing beneath the surface. The agricultural sector was in crisis. Overproduction led to plummeting prices, forcing many farmers into heavy debt. Manufacturing faced troubles too. While factories churned out goods, many workers' wages remained low, limiting their ability to buy what was produced. This mismatch created unsold inventories piling up in warehouses. By the late 1920s, these warning signs suggested the economy's foundation was shaky, yet the stock market continued climbing. Speculation, fueled by optimism and easy credit, pushed stock prices far beyond their true value. Many investors bought shares simply hoping prices would keep rising, not because the companies were genuinely profitable. The Dow Jones Industrial Average increased tenfold over 9 years, reaching a peak of 381.17 points on September 3, 1929. Economists like Irving Fisher declared stocks had reached a permanently high plateau. But others, such as financial analyst Roger Babson, warned of an impending crash. His September 5th prediction that a crash is coming and it may be terrific shook confidence, sparking a brief market dip known as the Babson break. Meanwhile, political tensions added fuel to the fire. The debate over the Smoot-Hawley Tariff Act, designed to protect American industries by raising import taxes, alarmed investors. Some feared it would trigger retaliation from trading partners and worsen economic troubles. On October 23, 1929, a key Senate vote surprised markets, intensifying fears about the tariff's impact. At the same time, scandals like the jailing of British financier Clarence Hatry for fraud weakened trust in financial institutions. By late October, the market's fragile facade cracked. On October 24th, dubbed Black Thursday, panic selling erupted. Nearly 13 million shares changed hands, a record volume, as prices plunged. The ticker tape lagged hours behind, leaving investors in the dark about actual prices. Leading bankers, including Thomas W. Lamont of Morgan Bank and Charles E. Mitchell of National City Bank, met to halt the slide. They enlisted Richard Whitney, vice president of the exchange, to buy large blocks of blue-chip stocks at above-market prices. Whitney's intervention calmed markets briefly, and the Dow closed down only 2.09% that day. But relief was short-lived. The selling resumed with renewed vigor on October 28th, Black Monday. The Dow dropped 38.33 points, 12.82%, a staggering single-day loss. The very next day, Black Tuesday, saw even more devastation. Some 16.4 million shares traded, wiping out $14 billion in stock value, equivalent to over $200 billion today. The Dow plunged another 30.57 points, totaling a 23% drop in just 2 days. Investors scrambled to sell, but buyers vanished. Despite efforts by financiers like William C. Durant and the Rockefeller family to buy shares and restore confidence, the crash deepened. The ticker tape ran late into the night, reflecting the frantic pace and magnitude of the sell-off. After a brief rally on October 30th, the decline continued through the fall and into the next few years. By July 1932, the market had lost nearly 90% of its value. The Dow bottomed out at 41.22 points. Its lowest in the 20th century. The crash was not just a market event, it triggered a banking crisis and a deep economic depression. As stock values evaporated, banks faced enormous losses, especially those heavily invested in securities. Many banks failed, wiping out savings and tightening credit. Businesses cut production, and unemployment soared. From 1929 to 1933, U.S. unemployment rose from 3% to nearly 25%. Poverty and despair spread nationwide. In response, the U.S. government took steps to stabilize the financial system. In 1933, President Franklin D. Roosevelt signed the Glass-Steagall Act, separating commercial banking from investment banking to reduce risky speculation. Stock exchanges introduced trading curbs, such as halting sales when prices fell rapidly to prevent panic-driven crashes. The crash's impact rippled far beyond the United States. Worldwide economies plunged into the Great Depression, a decade-long economic crisis marked by unemployment, poverty, and political upheaval. The crash shattered faith in capitalism and free markets, influencing economic policy for generations. Today, the Wall Street crash of 1929 remains a powerful cautionary tale. It reminds us of the dangers of speculation, over-leveraging, and ignoring economic fundamentals. It also highlights the importance of robust financial regulation and oversight. The 2008 financial crisis and even market turmoil during the COVID-19 pandemic echo lessons first learned nearly a century ago. Understanding this history is vital to safeguarding future economic stability. In summary, the Wall Street crash of 1929 was not just a sudden market plunge, but the result of years of imbalance, speculation, and economic weakness. From the optimistic boom and reckless speculation of the Roaring Twenties, through the terrifying days of Black Thursday and Black Tuesday, to the long aftermath of economic collapse and reform, this event reshaped the world. Its legacy endures as a stark reminder of how fragile financial systems can be, and how quickly prosperity can vanish when caution is thrown aside. The Great Crash changed everything. It taught us hard lessons about greed, risk, and the interconnectedness of economies. Most importantly, it showed us why vigilance and regulation are essential to prevent history from repeating itself. As markets continue to evolve, remembering 1929 helps us navigate the future with wisdom and care. The echoes of that fateful October still resonate today, urging us to learn, adapt, and never forget.